Friends, thank you for being here today. I want to begin by addressing the anatomy of the market chaos we are witnessing, which essentially amounts to a silent earthquake occurring beneath our feet. What if I told you that there was a $20 trillion trade created 3 decades ago that is about to unwind? And could it be possible that this single event might trigger a global financial crisis far worse than the meltdown of 2008? The global financial markets have recently experienced a period of extreme turbulence that can only be described as an absolute wild couple of days. To the casual observer, the massive intraday swings in major indices and the precipitous drops in high flying technology stocks appear to be isolated incidents of volatility. However, beneath the surface of daily ticker movements lies a structural fault line that is shifting, threatening to cause a global financial crisis far worse than the events of 2008. This phenomenon is being referred to as a silent earthquake, and its epicenter is not in New York or London, but in Tokyo. The chaotic price action has been staggering. Nvidia, the poster child of the artificial intelligence boom, saw its stock price tank from the top of the morning trading session down to a loss of 9% intraday. This massive decline resulted in the evaporation of nearly $500 billion in market value in a blink of an eye. Similarly, the NASDAQ 100 index swung violently, moving from a positive 2% gain to a negative 2.3% loss, representing a total crash of over 4% within a single trading day. These are not normal market corrections. They are symptoms of a much larger liquidity drain. Simultaneously, the cryptocurrency markets, often viewed as a canary in the coal mine for risk appetite, are flashing severe warning signs. Bitcoin has plummeted, dropping all the way down to $81,000, signaling that despite long-term bullish sentiment, the asset has entered a bear market. Ethereum and other digital assets have followed suit, tracking the broader withdrawal of liquidity from the system. While many market commentators and YouTubers act quickly to attribute these moves to short-term noise or specific company news, they are missing the forest for the trees. The root cause of this massive chaos and uncertainty is the potential unwinding of a trade structure that was created 3 decades ago. This is a trade so large that it is estimated to be worth anywhere from $3 trillion to $20 trillion in global borrowing. It is known as the Japanese yen carry trade. For 30 years, this trade has acted as a silent engine of global liquidity, artificially suppressing interest rates in the United States and inflating asset prices around the world. However, the conditions that allowed this trade to flourish are rapidly ending. Japan is effectively closing the world's largest money printing press, and as this massive volume of cheap capital is withdrawn, the global financial system stands on the precipice of a liquidity crisis of historic proportions. Now, to truly grasp the magnitude of this event, we need to deconstruct the Japanese yen carry trade to understand exactly how it works. To understand the severity of the current situation, one must first understand the mechanics and history of the Japanese yen carry trade. This financial phenomenon did not emerge overnight. It is the result of decades of specific monetary policy. In the 1990s, after Japan's stock market crashed and its economy entered a severe recession, the Bank of Japan made a historic decision. They dropped their official interest rates all the way to 0%. At that time, many other central banks and economies had interest rates hovering around 5, 6, or 7%. This disparity created a massive arbitrage opportunity. Think of it like taking out a mortgage for 0% interest. For 30 years, the Bank of Japan kept its rates near zero, essentially making the Japanese yen the cheapest currency in the world to borrow. Smart investors, primarily hedge funds and institutional investors, recognized this opportunity. They would borrow billions of yen for almost nothing. Immediately, they would sell that cheap yen and convert it into a currency that pays high interest, typically the United States dollar. Once they held United States dollars, these investors would purchase high yielding assets. They bought United States Treasury bonds, paying 5%, Australian corporate debt, or European stocks. The math was simple and seductive. Borrow at 0.5%, invest at 5%, and pocket the difference. This provided an easy 4.5 to 5% return on investment with seemingly minimal risk. This practice became the largest arbitrage trade in human history. However, the implications of this trade extend far beyond the profits of hedge funds. This was not a small, isolated trade. We are talking about an estimated $20 trillion of global borrowing. A huge amount of that borrowed yen went directly into the United States markets. The yen carry trade became the silent buyer of United States stocks and a major financier of the United States government debt. Japan is currently the biggest holder of United States treasuries, holding $1.1 trillion of United States debt. This means that the United States markets are standing on a foundation partly built with incredibly cheap Japanese debt. As long as the debt remained cheap and the yen remained weak, the money stayed in the United States, keeping markets liquid and yields suppressed. Your 401k, your superannuation, and your retirement funds are all unwittingly invested in this trade. The valuations of high flying tech stocks assume that this cheap leverage will continue forever, but that assumption died recently. The unwind is not just a theoretical risk. Recent financial events confirm it is happening right before our eyes. This brings us to the trigger, and we need to answer the critical question: why is this trade unwinding right now? The stability of the yen carry trade relied on one crucial assumption: that Japanese rates would stay frozen at zero forever. That era has ended. Japan is currently experiencing a dramatic economic shift that challenges traditional economic expectations. The country is moving from a period of chronic deflation to one of rising inflation. Recent data indicates that Japan's core inflation in October rose at its fastest rate since July, supporting the case for interest rate hikes by the Bank of Japan. This shift has sent shockwaves through the Japanese bond market. Japanese government bond yields have jumped to record highs. The yield on the 10-year Japanese government bond has gone from negative 15 basis points to 1.71%. Even more dramatically, the 40-year bond yield has soared from zero all the way to 3.7%. This is the highest level since the securities were launched in 2007. When Japanese yields rise, the fundamental logic of the carry trade breaks down. Investors are starting to see that the difference between Japanese yields and United States yields is no longer profitable enough to justify the risk, especially when factoring in the fees for trading currencies. The spread is narrowing. Furthermore, the Japanese government recently revealed a $110 billion stimulus package plan. While intended to boost the economy, this massive spending increases the supply of bonds and fuels inflation fears, driving yields even higher. There is also a political dimension driving this unwind, often referred to as the Prime Minister trade or the Mrs. Takaichi trade. Markets are reacting to the fear that Japan's political leadership will continue to push for stimulus, which forces the central bank's hand to raise rates to combat the resulting inflation. The market is pricing in a vote of no confidence in Japan's sovereign debt sustainability. Japan's debt load is staggering, standing at approximately 255% of its gross domestic product. Interest payments already account for 23% of annual tax revenue. Nearly a quarter of all national income goes just to service the interest on the debt. The mathematics stop working when interest rates rise above a certain threshold. Analysts estimate that every 100 basis point increase in yields adds more than 2.8 trillion yen to the government's yearly financing burden. The market realizes that the Bank of Japan is cornered. They must raise rates to save the yen and combat inflation, but raising rates threatens to crash their bond market and explode their debt service costs. This fear is causing investors to rush for the exits, triggering the unwind of the carry trade. With that context established, let's examine the mechanics of the collapse and the massive repatriation of funds that follows. The consequences of this unwind are mechanical and violent. It creates a vicious cycle of repatriation and liquidation. As the trade becomes unprofitable, investors rush to pay back their yen loans. To repay a loan denominated in yen, they must first possess yen. However, their capital is tied up in United States assets like treasuries and stocks. Therefore, the first step in the unwind is the selling of United States assets. Investors must liquidate their stock portfolios, their United States bonds, and riskier assets like Bitcoin. This massive selling pressure causes a flash crash across global markets as supply overwhelms demand. We saw a preview of this recently when Nvidia and Bitcoin tanked simultaneously. The second step is the conversion of currency. After selling United States assets, investors take their dollars and sell them to buy yen. This massive buying pressure on the yen causes the currency to strengthen. This is the worst case scenario for anyone still holding a yen loan. They borrowed the money when the yen was weak. If the yen strengthens by 20 or 30%, they suddenly need 20 or 30% more United States dollars to pay back the same loan. This creates a margin squeeze. If investors do not have enough United States dollars to cover the appreciated loan value, they are forced to sell even more assets, driving prices down further and strengthening the yen further. This is the spiral that experts warn could cause a financial crisis worse than 2008. We are already seeing concrete evidence of this repatriation. Large Japanese pension funds are currently withdrawing an estimated $1.1 trillion from United States Treasury bonds. They are realizing that keeping money in the United States loses them money when they hedge for currency risk. The largest foreign buyer of United States debt is becoming a seller. The impact on the United States bond market has been immediate and alarming. A recent 20-year bond auction in the United States bombed spectacularly. The auction saw a tail, meaning the government had to offer a higher yield than expected to find buyers. More concerning was the bid to cover ratio, which was the lowest going back to November of 2024. Indirect bidders, a category that includes foreign demand like Japan, saw their share plummet from a 6-month average of 65% down to 59%. This lack of demand is pushing United States Treasury yields higher. When Japan stops buying, or worse, starts selling, yields must rise to attract other buyers. We are seeing United States Treasury yields climb 15 to 40 basis points purely due to reduced Japanese demand. This creates a trifecta of doom. United States yields spike, equity markets crash due to liquidity drain, and the dollar weakens against the yen. However, this isn't just an external problem, it is compounding a severe domestic liquidity crisis right here in the United States. While the earthquake in Japan is the primary driver, it is exacerbating a severe liquidity crisis already brewing within the United States. The narrative that the United States economy is strong is crumbling under the weight of debt and a lack of cash. We are currently witnessing a liquidity hell in private credit markets. The private credit sector is experiencing a series of rug pulls where major lenders freeze lines of credit, causing immediate insolvency for borrowers. For example, on September 10th, Tricolor was essentially destroyed when JP Morgan froze an over $700 million warehouse line of credit. First Brands collapsed on September 28th amidst suspicious auditing issues. BlackRock's Renovo Homes went from valuing assets at 100 cents on the dollar to 0 cents on the dollar virtually overnight. This liquidity crunch is exposing zombie companies, firms that are barely surviving on cheap debt and have no real cash reserves. A prime example is Fat Brands, a company that franchises recognizable restaurant chains. Their financials are terrifying. They hold merely $2 million in cash against a staggering $1.2 billion in debt. This ratio is unsustainable. As liquidity dries up and rates stay high, these companies will face bankruptcy, further dragging down the economy. The technology sector, particularly the artificial intelligence bubble, is also showing cracks unrelated to Japan, but compounded by the liquidity drain. There are growing concerns regarding the financial health of market leaders like Nvidia. While the company has been the darling of Wall Street, scrutiny is increasing regarding its finished goods inventory, accounts receivable, and its relationship with entities like CoreWeave. Furthermore, there has been significant insider selling. SoftBank, a massive Japanese conglomerate, sold its entire $5.8 billion stake in Nvidia shortly before the recent market volatility. Even more notably, Nvidia's CEO Jensen Huang completed a massive sale of his own stock on October 28th, literally one day before the market top on October 29th. This timing has raised eyebrows and suggests that smart money is exiting the casino while retail investors are still buying the dip. There is also a long-term risk known as the buried depreciation trade. This theory posits that the current boom in artificial intelligence chips ignores the reality of depreciation. These chips are depreciating assets, yet companies are capitalizing them as long-term investments. When supply eventually catches up with demand, the value of these chips will plummet, forcing companies to write down massive losses. While this is a future risk, the current market sell-off suggests that investors are trying to front-run this eventuality, getting out now before the bubble bursts. Adding fuel to this financial fire, we must also consider the geopolitical amplifiers, specifically the connection with China. Adding fuel to this financial fire is a deteriorating geopolitical situation in East Asia. The financial relationship between Japan and the United States is being complicated by rising tensions between Japan and China. China is furious at the new Japanese prime minister following comments made regarding Taiwan. China considers Taiwan to be part of its sovereign territory and a red line issue. The Japanese government, however, recently stated that if China were to invade Taiwan, Japan would take military action to protect the island. This statement has enraged Beijing. In retaliation, China is beginning to impose economic and cultural sanctions. Japanese concerts in China are being abruptly canceled, and business uncertainty is rising. This is significant financially because China is a major trading partner for Japan. If China imposes severe economic sanctions, it will worsen Japan's already precarious economic situation, widening their deficit and increasing the pressure on their government to find funding. This geopolitical friction makes it even more likely that Japan will need to repatriate funds from abroad. They will need to bring their money home to support their own economy, accelerating the selling of United States treasuries and the unwinding of the carry trade. All of these signals converge into what I can only describe as a financial tsunami warning. We are currently witnessing a convergence of factors that signals a financial tsunami is approaching. The world is adjusting to a Japan that no longer gives away free money. The silent earthquake has begun, and the shockwaves are traveling through the global financial system. The timeline for this crisis is accelerating. The Bank of Japan is set to meet on December 18th. This date is viewed by many as a potential judgment day. There is a 50% probability that they will raise rates again. If they do, we will see sharp, violent movements in all markets. The Federal Reserve in the United States is powerless to stop this process because the liquidity drain is originating from the largest creditor in the world. The consequences for the average investor are severe. We are looking at a scenario where United States mortgage rates could quickly spike from 7% to 8% or higher as Treasury yields rise. Corporate debt servicing costs could skyrocket by 60%, causing a wave of corporate bankruptcies among the zombie class. Valuations for the S&P 500, which assumed interest rates would stay near 2% forever, may have to reset. With rates at 3.5% or 4%, fair value for the stock market could be 35% lower than current levels. The entire trade collapses the moment the Bank of Japan decides to lift interest rates, and that is what we are seeing right now. The global financial system has been standing on a foundation built with incredibly cheap Japanese debt. As that debt becomes expensive, the foundation crumbles. The liquidity that fueled the artificial intelligence boom, the crypto bubble, and the resilience of the United States consumer is being pulled back to Tokyo. Finally, we must look beyond our borders to the global blast radius, affecting Europe, emerging markets, and signaling the end of the easy money era. While the United States naturally occupies the center stage in this financial drama due to the sheer size of the Treasury market, the blast radius of the yen carry trade unwind extends far beyond American borders. The contagion risks are global, threatening to destabilize both European sovereign debt markets and fragile emerging economies. Japan has not merely been the banker for the United States, it has also acted as a silent, stabilizing buyer of European debt. For years, Japanese institutional investors, starving for yield that was unavailable domestically, aggressively purchased government bonds from countries like France, Italy, and Spain. This inflow of Japanese capital helped to compress yields in the Eurozone, effectively papering over the structural fiscal weaknesses of Southern European economies. Now, as the ghost of debt returns to haunt the continent, the withdrawal of Japanese buyers leaves a dangerous void. If Japan repatriates this capital, European bond yields will almost certainly spike. This reignites the dormant fears of a sovereign debt crisis as nations with high debt to GDP ratios suddenly face significantly higher borrowing costs without the buffer of foreign demand. The European Central Bank, already grappling with its own inflationary battles and stagnant growth, may find itself fighting a multi front war as bond spreads widen between Germany and the peripheral nations. Furthermore, the impact on emerging markets could be even more devastating. The carry trade mechanism often funneled borrowed yen into high risk, high yield bets in developing economies, from Mexico to Brazil to Turkey. These nations rely heavily on foreign capital flows to finance their growth and stabilize their currencies. As the yen strengthens and global liquidity contracts, these capital flows can reverse with terrifying speed. We have seen historically that when the carry trade unwinds, emerging market currencies tend to fall anywhere from 1 to 3% within a mere 30 days. This sudden devaluation makes dollar denominated debt held by these nations excruciatingly expensive to service, potentially triggering a wave of defaults and economic instability across the global south. Ultimately, this phenomenon represents more than just a market correction. It signifies the definitive end of an economic era. For over 15 years, and arguably stretching back 3 decades, the global financial system has operated under the regime of easy money. Investors have been conditioned to believe that central banks will always intervene to suppress volatility and that liquidity is an infinite resource. This created a moral hazard where risk was consistently underpriced because the cost of capital was artificially held near zero. The buy the dip mentality was a rational response to a market rigged by constant stimulus. However, the unwinding of the yen carry trade marks a structural regime change. We are transitioning from an era of abundant, cheap leverage to an era of scarcity and capital discipline. In this new paradigm, return of capital becomes more important than return on capital. The psychological shift for a generation of investors who have only known zero interest rate policy will be profound and painful. The volatility we are seeing is the market trying to find the true price of money in a world where the largest printing press has finally been switched off. As liquidity evaporates, correlations between asset classes tighten, meaning that stocks, bonds, and crypto may all fall together, leaving few places to hide. The financial tide is going out, and as the old adage goes, we are about to discover who has been swimming naked